Hi, this is Keith Schneider, CEO of MarketGauge.com, and this is December 15th, 2013 edition of Market Outlook. Don't forget to sign up for this and get your free version, both in text and video format, at www.marketgauge.com. And also keep a lookout. We're doing a new course, and we're coming up with a new service as well. And Mish is doing phases and forecasts for 2014, which is a very comprehensive document. So stay tuned and watch for emails for that coming from Market Gauge and Mish as well. So let's start off actually by looking at some of the key indices. Spiders here. Let's take a look at the spider chart. A couple of things have occurred. One, we pulled back into the main channel this week. So we had been a bit overextended and moved back into it. Let's get a little orientated here and see where the daily chart basically takes us to. As you can see, this had been the channel that we had put in quite a while ago. It's sort of a combination of a channel and a sort of a megaphone pattern. You can see here's the bottom of the channel. We come in around the 155 level, but that's the bigger channel. And to the upside, if you take the top end of the channel, you can see we touched down back in April of 2012, again in the summer of 2013, and again we hit to the very top of it in the month of November. Tried again here just last week and sort of failed pretty strongly. You had a series of 4 or 5 down days in the spiders. A couple things to note here. Number one, on the downside, if you look at the number of volume bars that exceed the volume of the prior day, distribution day, we've clearly had about 3 or 4 of them over the last 2 weeks. And even though we've sort of nudged up and maybe are flat over the 2-week period, we've only got really one, maybe two accumulation days here that I can see in the S&P. So there's definitely some distribution, some profit taking place. We're now trading under the 10-day moving average, and we do have this potential double top formation. You can see as we've approached new highs on a number of days here, new high here, new high here, new high here, and new high over there, we've not been able to follow through and have really made actually downward action over the last several weeks. So a somewhat of a decline wouldn't be all that surprising at all. However, the longer term trend still remains intact, but you never know what can happen, and so we let the market tell us. But for right now, you can see longer term trend intact, potential double top playing out, but we are, as you will see in a moment, getting not quite completely oversold, but you can see 1, 2, 3, 4 straight down days, which has been unusual considering this market in general, certainly since we came back in September. So this is action to note. The number of down days certainly has exceeded the most recent past. Potential double top at the high of the upper end of the channel, and a lot more volume seems to be coming in on the downside rather than the upside. So that is of concern on a shorter term basis. So we're going to keep our eyes out on that. Now, on a short-term pattern, you can see that we have an inside day in the spiders. So considering that we are down 4 days in a row, and also we're sort of at a relatively important level with this potential double top, right? And I'm going to get into the market internals a little bit more. I would be inclined to be able to follow this inside day breakout either way. Now, let's take a look at some of the other market internals. McClellan Oscillator actually got to a oversold area and has hooked up, so that is a definite positive. However, what we'd like to see is a bit more confirmation on our shorter term indicators as well as the longer term, which looks out. The McClellan goes out 3 weeks or more in its calculations, so that's more of a longer term type view. But when used in conjunction with the advanced decline and up down volume on a 10-day basis, they're all getting oversold and turning up at the same time. That is a good confirmation. Now, what's happening here? Advanced decline has not improved. So as the market's been selling off, the breadth has definitely been weakening, which is a little bit different than what's going on the longer term basis. Remember, the advanced decline chart that I have here is only a 10-day, and as is the up-down volume. Now, the up-down volume certainly hasn't reached any climactic level, and it's sort of the same level that it reached back in October. So let's watch to see if we can get this advanced decline on the 10-day hooked up and this all turning. Then you would have 2 out of our 3 indicators all pointing up, which would be a pretty good indication that the market has bottomed here and we just got a very shallow temporary sell-off. Now, this is not to say that there's not potentially more room on the downside as well. Let's follow that inside day rule, and that should lead us to a profitable trade and probably a good setup whichever way it plays out. Let's take a look at bonds. TLTs, these are the 20-year. Again, we're in the same type of scenario that we've been in. The long-term 80 monthly, this is the green line right here. You're hanging on, you're sort of hovering. I'm not sure. I think you might have closed slightly under it, but that key level is the 102 level. Obviously, depending what happens with the Fed, the taper, this is all going to play out in this chart, but it can potentially wreak havoc on the market if really you get some very sharp liquidation. Remember, we've now traded in a really narrow range for 1, 2, 3, 4, 5, almost 5 months. So that's enough compression to move this market pretty sharply in either direction. So let's keep track of that. Let's see what the daily chart looks like. Again, the daily chart suggests, as we mentioned on the monthly, plays out that basically over the last 4 or 5 months you've traded in this narrow range. And by the way, if we break that 102 level, that's a pretty critical level. You can take that and say the count is about 7 or 8 points. So you can see this thing, the TLTs, drop to well under 100 based on the breadth and the distance of this compression zone right here. And again, right now on the daily chart, we are accelerating to the downside on the 50-day, so you definitely want to watch that. And this whole thing is a bearish phase as well. Now let's take a look at the VIX, which is the sentiment indicator. A couple things to notice. The VIX has now traded above the 200 and the 50-day moving average. So that in itself is a negative sign. So sentiment is definitely flashing a bit of a warning here. Again, if we trade above the 16 level, obviously we're going to be trading outside of the Bollinger Band, but that can persist, and that would not be a good sign for the market. So we definitely have a couple of warnings here. Number one, you can see that the breadth indicators are moving lower, as we noticed over here, right? And not really finding too much support. The market sentiment definitely giving us a negative reading, so that is definitely cautionary. The short-term pattern in the market is definitely iffy, so further extension of this correction would not be surprising at all. Let's take a look at gold. Gold is pretty interesting as well. As you can see, the gold also playing out a pretty similar pattern to the TLTs as well. And you can get a pretty interesting view here. First of all, let's take a look at the monthly chart. So interesting, much like the TLTs and the bonds, gold's long-term uptrend is also being attacked as well. So it's interesting that both of the 80-month moving averages, both on the bonds, both on gold, are being attacked, and its long-term trends, right, that are barely holding on in each one of these things are about to shift. Now again, if we take the count on the gold chart, let's take a look at the daily chart. And if you look, I'm going to put in a horizontal line here, which is a important support level. And so this level here in gold, you can see is sort of a swing level. Once we attacked it up here, it basically held. It seems to be this swing level, right? You had this huge sell-off, rally, contained it, move back up above it, and I mean you could move it up a little bit more closely on a closing basis if you wanted to do that. It sort of gives you a bit of a zone there. So somewhere around the 122, 123 level, that's critical. If we can get back over that, you actually might have put in a double bottom in gold as well. But for now, we have acceleration on the 50-day to the downside. The market's looking heavy. If we do break down under these critical lows that were put in at the end of June, you're looking at a potential move from this neckline. You can take a look at this and say shoulder, head, shoulder, neckline, and you're talking about a drop of somewhere, if you take the count from the neckline to the top of the head right here, 135 and 122, you're talking about a $13 to $15 move, depending on how you want to draw in your neckline over here. Again, it could be put in a little bit lower, or if you want to do it on a closing basis, it would be a little bit higher. But you're talking about a good $130 to $150 drop in gold bullion, or about which equates to about $15 or so, $13 in GLD. One last thing, let's take a look at Tesla. Tesla we sort of featured last week. Elon Musk was voted CEO of the year for 2013. Not surprising. You had a bunch of things really go well. Tesla Motor Cars doing great. Had this parabolic move from 40 to 190. At this point right now, you're still in a strong warning phase, right? We got right up to the 50-day moving average. Elon cleared up the problem with the fires in the car, got the letter from the German safety board stating that Tesla S cars are safe, which is a good vote of confidence, a very important one. And the market promptly went from about 125 all the way up to 150. So you're talking a nice, within a couple of days, really, or a week or so, almost a 20% move. So that's pretty good. Now, in terms of this particular chart, you can see the 10-day moving average here right around the 140 level where it took off from on Thursday. Now, we also approach the 50-day moving average. So we're sort of bound between a warning phase, a strong warning phase in Tesla, And wouldn't be surprised if you can take out that 10-day, another test, maybe down to the 200. On the other hand, wouldn't be surprised to see a spurt, and if we reconfirm and get back over this 50-day moving average, you can certainly see a test of the new high. So we're going to let the market tell us exactly how to play it, use the short-term patterns along and overlaid depending on what the phase is doing is the way to go. All right, that's it for now. Have a great weekend, and see you next week.